Traders, potential progress with the US and Chinese talks in Geneva this weekend. How is the dollar going to react with a key week? US CPI, retail sales, amongst other data. Market's going to be interesting. Ken Chigbo back with another E8's market fundamental update. Let's jump straight into this. So, guys, let's jump straight into this. So, a lot of focus, of course, has been on these talks between US and Chinese officials where they're meeting, obviously, on the trade war, on the tariffs that both have obviously implemented on each other, where it's been very much tit for tat. US slapping tariffs on China, retaliating back. And these talks in Geneva, apparently, both sides made progress. At the time recording this, it's Sunday today. They made progress during their talks on Saturday. Trump went and announced that, great progress has been made. We're going to have this reset. But look, this is good. Okay, this is good. But I'd always take Trump and what he says with a pinch of salt. And with these talks, obviously, there's still a very, very long road ahead and things are extremely delicate. Nothing's been agreed. They've just had initial talks. But this may be enough for the markets to cling on to and be happy with, which could provide relief. Because remember, the dollar's been selling hard. It was selling hard because of obviously all these worries around tariffs, particularly whereas the world's largest economies, US and China, going head to head, back and forth with these tariffs that are going to hurt both respective economies. So this is likely to provide some relief at the open for the dollar. Likely to see some relief for stocks as well, creating a little bit of risk appetite there, but dollar most likely to wanting to get a bit of a bounce. Now, if we take a look here at the dollar, obviously now we're heading for the third consecutive week in the green, as you can see, 1, 2, 3. But for me, we're still vulnerable. Remember I said, obviously, I've gone over this for the past few weeks now, just obviously that monthly for the month of April, how bearish that was. Obviously, all this downside pressure, we know, okay, with the tariff uncertainty, with question marks over the US economy, all these red flags, and how the implication of these could be bad with stagflation, all of that. Now, one thing that also helped the dollar in the latest week, before we sort of break this down more technically, one thing that helped, if you look at last week, we had obviously the FOMC rate decision, which was in focus, where they kept rates unchanged at 4.5%. And Powell just noted he essentially pushed back on rate cut bets for June. Okay, he said markets, look, we're keeping rates where they are for now. One of the key reasons is because inflation remains sticky. But with some of the comments that he mentioned, if you listen back to the press conference, the amount of times he mentioned the word uncertainty, 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 quite a few times. And it is very uncertain because they just don't know yet what's going to happen, the result of these tariffs. They don't know how long this war is going to go on for in terms of the trade war. They don't know the serious implications that it's going to have on the US economy. But what we do know is there's definitely worries around stagflation. So price of goods and services are high, which is why the FOMC are keeping rates high for longer to try and bring down those goods prices. We saw, obviously, remember GDP cooling. We've seen consumer confidence heading to the south. Data's just cooling in the United States. So we're definitely arguably in this period of stagflation. Fast forward, obviously, to this week, right? Key data points in the form of CPI, so US Consumer Price Index, expected to be sticky here on an annualized and on a month-to-month and on the core. And I wouldn't be surprised if, obviously, Jerome Powell at that latest press conference, he is noting about sticky inflation. Perhaps they've already got a large insight into these numbers already. So potentially, these may come out higher, which, I mean, if they come out in line, they may provide a little bit of resilience for the dollar because obviously it reinforces that higher for longer in terms of rates not moving there. We've got retail sales, and I wouldn't be surprised these cool because we have seen a softening in consumer confidence of late. I know retailers, some key retailers and likes of Target, Abercrombie and Fitch, their outlooks have declined, in terms of their outlook for sales. They're seeing, because of weaker consumer confidence, the uncertainty with tariffs. So I wouldn't be surprised if these numbers disappoint to the downside, come out lower. And obviously, we've got the University of Michigan consumer confidence, which I would, given the current trends of consumer confidence, that heads to the downside in terms of general sentiment there. So data this week initially could be supportive on the back of the, not breakthrough, but the progress made in trade talks. But then there could be some downside if we do see poor retail sales numbers as feeding into that narrative of stagflation and lower growth in the United States and, that fear of recession. Dollar here is at a very key level. We're really retesting this sort of 150 mark. Now, I said to you guys in previous videos, when you look at structure here, we're still lower highs, lower lows, right? All that good stuff. This structure remains intact. Okay, if we manage to grind down this zone, I'm leaning still towards downside. But if we manage to somehow grind this zone down, we're going to fly in towards 103.50. I would still like to see some rejections or potentially a fake out above this zone to continue to the south. At the end of the day, I'm going to trade what I see, but I think if we do push to the upside, I could feel like it could be a fake out and then we continue to the south. But if we get that breakout and retest, we're going to have a nice run to the upside, which of course would weigh on euro, okay, and the rest of the dollar peers. Euro obviously makes up over 50% weighting of the Dixie. There isn't any major data this week from the euro, but I'm just bringing this up here because we are sort of seeing the flip side to the Dixie. You know, the Dixie there with that potential bearish wedge, rising channel, bearish flag, have you on look at it. This is all of our power, that momentum and the consolidation. And you can see the flip side to the euro, potential big bullish flag here, all of the pole here, subject to breaking out. And you could look at this as sort of trying to bottom out with the one bottom there, second bottom here, and maybe go for that neckline up at around 1350. But that's going to be very much dependent on sentiment and obviously progress around these tariffs. And of course, that US data. But that'll be your upside scenario. In order to break to the downside, if we do see the Dixie flying towards 103.50, then this is going to have quite a deep correction. We'll be coming down to 111. It's just a case of zone to zone. I've got my key zones marked up here and I'm just prepared for both scenarios. So keep an eye. Certainly a lot of volatility still in store for us this week for dollar related. GBP, we do have key data from the UK. And this comes on the back of last week, right, where we had the Bank of England rate decision where they did cut rates. Let's just bring it up here. Okay. But it was a bit, it wasn't as dovish. Why? Because when you look at the vote here, markets were expecting that all 9 members were going to vote unanimously for that cut of 25 base points. However, 7 members voted and there were 2 dissenters. So that suggests that the the MPC, the Bank of England, are still a little bit split. So if we've got less people, not everybody calling for that rate cut, then that's not as dovish as it could have been as markets were expecting here. Also, in terms of the Bank of England, similar to the FOMC, they are going to be gradual because inflation's still sticky. They want to see inflation coming down, and they did stress about wage pressures. So wages, remember we noted before, wages are still high in the UK. So if wage is still high, it means people are still getting paid more money to go out and spend more money and keep prices of goods and services higher because they're still stimulating the economy. Now, if you look here, obviously, on that topic of wages, we do have labour market data this week from the UK. Claimant count, when you look at claimant count in the UK, has generally been okay. You're not too many unemployment claims. Wages, interestingly, expected to drop down quite a bit, fairly to 5.2% from 5.6. I don't think we're going to see such a drastic drop, especially given those comments from Bailey over the at the decision where he was stressing about wage pressure. So perhaps he still got some insight on that. If that's the case, then we're going to see rate cuts being pushed back further. You know how they've been cutting, pause, pause, cut, pause, pause, cut, pause, pause. That's what they've been doing in terms of their rhythm, if you like. And I think that will be maintained, especially if we do see this good data. And if that data does remain buoyant, good, resilient labour market, then of course it's going to support GBP. Keep an eye on that unemployment rate as well. Expect to tick high to 4.5%, which would be the highest we've seen it since, whoa, a long time, guys. Look, well, it's still going here. We haven't seen, okay, all the way since 2021. So that'd be the highest unemployment rate since 2021. But let's see. I think labour market still should be quite resilient, especially given the fact that we've seen lower unemployment claims for a little while. But in terms of when you look at GBP specifically versus the dollar, so we're just using this as a base case. Look, on a weekly, starting off with a monthly, as I said to you guys before, I'd still like to see that pushing to the upside, filling that wick, go back above 134. On the weekly, you see there was the risks of this being a double top. It doesn't look like we're going to because we're fighting. We're holding this ground here at sort of 32.50. You can see that holding ground there. We're going up for another challenge on a daily. It's just a lot of consolidation right now. And you could argue that this is a massive potential bull flag here. And we're going to try and take another push to the upside. When you look at structure here, obviously you can just see a lot of consolidation, but we're trying to break out. You see here again, structure to the downside, lower highs, lower lows. And now obviously we're trying to go and break for the structure and try and regather some momentum to the upside. Take out 33.50 is the next major level to keep an eye on in terms of resistance. Then deal with 134. If we break down 134, this flies another 150 pips, in my opinion, up towards 135.50. Okay, which would be the highest levels that we've seen since when? Is it 2021? Okay, 2022. So here, Feb 2022. So I think that could be seen if that data is supportive and we do get a pushback on rate cut bets for the Bank of England. Aussie dollar, we do have key labor market data. And this is important. Why? Because markets are trying to price what the RBA are going to be doing next as to whether we're going to get that rate cut. By the way, this is going to be next week, which we'll talk about obviously in our next video. But markets are largely pricing that they're going to cut by 25 and then again pause and assess everything. The reason being is because we have seen when you look at CPI, trimmed CPI on the annualized level. It's come back within the RBA's target range. Their targets range between 2 and 3%. I think it came down to 2.9% on annualized level, which is back within their range. So I think they'll cut and then observe for a while. So it'll be a bit of a neutral cut. They want to still understand the outlook with these tariffs, what's going on here, because that's going to influence their decisions. But in terms of the labor market, when you look at it, wages are still relatively healthy. Okay, we have seen a bit of a decline, but generally speaking, still relatively holding good ground on a quarter on quarter level. The employment change, when you look at the employment change, we've had a bad couple of numbers here, okay, in terms of less jobs being added in the economy or being seen in the economy. Unemployment rate expected to remain steady at 4.1%. So with this data, obviously, it needs to be higher in order to support that potential that we do get that neutral or hawkish cut next week from the RBA where they cut and they're like, look, this is a one and done for now until we see things deteriorating or we need to reassess. I just want to note as well on just bring it up here on Saturday we had Chinese data, and I'm going to note this because it's very important to note. When you look here on Saturday, CPI and PPI prices in China continue to fall, which is deflation, which is economic worries, of course. If prices of goods and services are just continuing to fall, that means the economy is suffering, right? People are not spending money. There's not enough business being done. So prices are just going down, 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 down. And remember that China is Australia's biggest two-way trading partners. Anything negative economically that's happening with China, it affects Australia. So just it was just worth of note of that. And obviously with these tariffs, depending on how those go in terms of really the progress, if there is any substantial progress in those tariffs, i.e. the tariffs get largely reduced, then obviously that would be positive for AUD. Now, when we look at AUD here, obviously on a monthly, we've seen signs of a bit of slowdown, a little bit of underperformance when you look at comparison to sort of GU and EU, because there's a lot more volatility there with AUD being exposed to China and this trade war. On a weekly, we've seen a slowdown. You know, remember we broke out of this range where we're capped to the upside at 64, going for a bit of a retest here. Can you see that there? Obviously, if this data is bad, we're going to suck back within this range, and there's going to be another mundane sort of range there for AUD. On the daily, excuse me, guys, on the daily, we've sort of trying to hold this range, where we've been consolidating. Obviously, this is very much. We probably will catch a bit of a bid potentially on this progress that's being made with AUD versus some peers. Dollar may be a little bit tricky because dollar's going to try and react positively to this as well. But your downside scenarios is breakout and retest of this zone, and then we're sucking back it within this range, coming down towards sort of 61.50, which makes sense. And then the next zone below that would be 60, 59.50. Okay, so keep an eye on this labor market data. It's very, very important, guys, ahead of RBA next week. All right, so once again, a week filled with volatility, an amazing week we're in store for. We're blessed right now. I continue to say it, we are blessed as traders with all this volatility. Other than that, have an amazing and a blessed week, and I'll catch you on the next video.